Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we break down the major themes and events driving currency markets this week and in the weeks ahead. Today is a European special for the Currency Exchange, where we look at the implications for Europe of the Trump-US presidency. The last 2 weeks have really highlighted the security concerns of a Trump presidency in regard to Ukraine and also security guarantees for the rest of the European bloc. Today I'm joined by Robson, who's our European head of G10FX. Paul, I'm keen to get your views on what are your main takeaways from recent developments over the last 2 weeks.
Yeah, it definitely feels like a historic week in international politics. I think there's going to be a lot of PhDs written, articles written, and careers ultimately made discussing what we've seen this week. It was certainly a surprise to markets. I think that's one of the key messages. You only had to look at how politicians were scrambling around to have meetings, to change speeches. If this was sort of fully understood and pre-warned, then that wouldn't have happened. And like you say, it was a dramatic shift in the potential defence architecture of Europe, one that's been in place for sort of 70 years, and it seems to have moved really quite quickly for Europe, but as you say, most obviously for Ukraine. Just listening to Vice President Vance's speech in Munich, it was clear that the situation had moved pretty quickly, and also just the policies and the rhetoric and the discussions with Russia, I think, were sort of new and important information. So I think this week will echo a long time into the future, and it will be interesting to see how things play out and how international markets and financial assets adjust to that environment.
Yeah, and on that point, what do you think, the main implications are for European financial markets on the prospect of Ukraine ceasefire or less, US security backing for Europe?
Yeah, at some level, this has its origins in the new Trump administration's plans or drive to get the twin deficits down in the US. So trying to get Europe to spend more on US-made goods, to spend more on military equipment. I guess they would be hoping US military equipment, and also to take a greater lead in their own security. Maybe it's got a little bit of a desire to have deals made. I think that's an important part of it. So we still have to wait to see to what extent this actually carries on into the future. There's always going to be scope for negotiations and concessions under this new administration. That's what we learned from the first sort of Trump 1.0 administration. So I think that's the backdrop. I think it's probably more important for European government bond markets than it is necessarily directly and immediately for the currency, the euro. If you think about the need to increase defence spending in Europe, every 1% of GDP increase in defence spending is 150 billion euros. And that's just in the first year. You continue that on into following years. So at a time when there's quite a lot of bond supply around to be absorbed, that's obviously new and important information. We've still got to wait to see how it's funded, whether it's at a national level or the EU level, but ultimately it feels greater defence spending's coming. Maybe that's growth supportive, but again, it comes back to what you buy and who you buy it off in terms of whether it stimulates the economy. But it comes at a time when we've been worrying, or markets been worrying about maybe deindustrialization of the euro area and the European economy. So maybe that comes as a positive. Another positive, actually, for the currency, I think, is in terms of reform at the sort of EU level. What we've seen over the last sort of 10, 15 years is that reforms tend to come when you have a crisis or a significant change in Europe. You saw it in the periphery crisis, for example, you saw it in COVID, and maybe this is just another one. And when I think about Draghi's blueprint for reforming Europe, whether it's environmental policy or industrial policy or deregulation, those kind of things, then maybe that's ultimately seen to be a positive. So again, it feels like it's a slow burn, small positive for the euro, but more immediately for European government bond markets. But everything that's been happening this week clearly is going to have an impact on your currencies and CE3. So, Eimear, I'm really keen to hear how you're seeing the events of this week on your currencies and markets.
Yeah, it definitely has big implications for Central and Eastern Europe. And actually, back in December, we went long the Polish zloty, really on that expectation that under a Trump presidency, we saw a Ukraine ceasefire as increasingly likely, with a base case that something would be agreed in Q2 this year. The trade has performed extremely well. Just this week, it's hit its target of 4.15 against the euro. This is really kind of primarily based on how vulnerable and exposed Poland was to the Ukrainian conflict. They are the NATO ally on Ukraine's western border. They have been kind of crucial in kind of providing the logistics for all that military support. And I think you can really see, the security implications this conflict had for Ukraine when you look at how much they've ramped up defense spending. So Poland, is well exceeding that 2% of GDP defense spending. And when it comes to NATO requirements, they're actually up towards 4%, so actually double their target. And they have been running, 5% fiscal deficits for consecutive years now because of this significant outlay. This was also backed up on the ground by a very conservative central bank who has kept interest rates on hold since October 2023, and also a more positive growth environment. When you look that they are, rebounding and recovering from a manufacturing downturn last year. So, as it's not as compelling as the trade once was, but we definitely see room for actually Poland to appreciate further as we get more developments around a potential negotiated settlement for Ukraine. So we are looking for levels against the euro of 4.12 and 50. But Paul, it wasn't just kind of security risk or Ukraine that was in focus. There's also trade implications from a U.S. Trump presidency. I wonder, how are you viewing these? Are these front and center in your mind? Are they driving, currencies?
Yeah, it, like you say, it just wasn't the sort of architecture of European defence. It's changing for the first time in sort of many a generation. We also had a week of more tariff threats or a discussion about tariffs from Donald Trump. I must admit, I'm struggling to keep up with them all. Certainly, which states are in play, which ones have delayed, which parts of tariffs are been delayed, which ones are been enacted. But this week it was talk of tariffs coming on US auto imports, pharmaceutical goods, and semiconductors as well, and that's a meaningful escalation. Trump talked about these tariffs coming in April. Remember, we've also had a series of delayed tariffs on Canada and Mexico. Some have already come into play for China. But I think one of the themes here is actually the date stamp on some of these tariffs is being pushed back, and they're sort of coalescing around sort of April time. Maybe they'll ultimately be delayed a little bit longer. And I think this ties in with the US budget bill that Donald Trump is hoping to get through Congress, because it puts I think the tariff and government policy on a better footing because it goes through Congress. At the moment, Donald Trump has talked about these tariffs. He's enacted an economic emergency act, and he's writing executive powers. But there's going to be pushback from Congress because he's doing this unilaterally without the support of Congress, or at least not going to the House and getting sign off for it. So if he can tie the tariffs and other policies in with a new budget bill. I'm sure he'll talk about it being the biggest ever, the best, the most beautiful budget bill that they've ever had. But I think that's important. Another point I think is important for the currency and the dollar is I think markets might be moving away from simply seeing more tariffs, higher tariffs as a simple, naive dollar positive as other countries allow their currencies to weaken to offset the impact. And maybe the market is now having one eye on hard landing risks in the US. So I'll be watching equity markets particularly closely. And if those markets start to worry, or the risk premium in US, I'm so used to saying risk premium regarding UK assets, but this is for US assets. Maybe the dollar starts to weaken a little bit. And it's interesting to see that as we came in to record this week's podcast, sterling dollar was drifting higher, euro dollar as well, and dollar yen was lower. So definitely, it's not all plain sailing for the dollar, and simply the dollar's going to go up. I think is a key message from this week's tariff news. But tariffs are obviously for a whole range of currencies and economies, not just Europe and Canada. So I'm curious to know how you're seeing the latest tariff news on emerging markets currencies more broadly.
Yeah, if there's one economy that stands out as being the most exposed to Trump trade tariffs within my region, it's the Czech Republic. Czech's economy is basically, combustion engine, German manufacturing. That's basically, it's a proxy trade of that. And it plays out in all the statistics. So if you look at Czech exports, 25% of them are car and spare car parts. 15% of the labor market is actually directly employed by the auto industry. And there's also concentration risk. So 57% of car production capacity in Czech Republic is just one German car manufacturer. I have to say that Czech koruna has been frustratingly resilient in all of this. And to be honest, I think markets are justified in this. We've seen time and again that, these Trump trade tariffs don't actually, get realized into actual policy. There is room for negotiation. There are delays. There are compromises and agreements to be made. Well, I know you mentioned it before, political risks in the UK, and I cannot let you go without asking you about the UK. We've obviously seen a raft of UK data. It is the big UK data week this week. What did you make of it, and has it changed your overall outlook on sterling?
Well, I think the one sort of headline for all the data that we saw was that it doesn't change our views dramatically, certainly not in terms of the currency, and certainly not in terms of our Bank of England call. We still think the Bank of England cuts interest rates at a quarterly pace down to a terminal rate of 4%. I think the dollar was supportive of that view, and it saw markets move a little bit closer to our view here at NatWest that the Bank of England stays cautious, and the Bank of England that stays cautious is probably helpful and supportive of the currency. And it's interesting to see, as I mentioned a little time earlier, that sterling dollar is moving higher. The data just suggested that inflation's just a little bit more persistent, and therefore the Bank of England can't be sure that it's on a sustainable path down to target without policy remaining more restrictive. And the labour market also suggested that the employment trends that we've seen maybe have moderated a little bit. Maybe the labour market isn't weakening as much as some had feared. And again, some of the wage data remain very high. Going back to the service sector, inflation numbers as well, they were not consistent with a 2% inflation target. So Bank of England stays cautious, supportive of the currency. Just very quickly, there's sort of four drivers that I continue to focus on. So the first one is that central bank policy differential. You have worries about fiscal policy. That's something we have to keep an eye on, because this increase in defence spending, I know that it's got to come out of managed expenditure, and they can't borrow for day-to-day current expenditure. So we'll just watch how bond markets react. Stagflation risks are still with us, and there's still the tariff risk. We like to think that maybe the UK isn't impacted as much as other economies around Europe, but this focus on perhaps VAT as a tariff, if that's how the US administration sees it, we have to be mindful of that. So still an uncertain outlook for sterling dollar, but ultimately we think sterling does relatively well against the euro and just a little bit higher against the dollar.
Yeah, it does seem that the UK is having trouble, like a lot of central banks, kind of like stamping out those last embers of inflationary pressure. Well, thank you so much for joining me today. That's probably all we have time for. Guys, thank you so much for joining today's podcast. If you do like the podcast, do remember to click like and remember to subscribe so you get the latest episode first. Thanks again.